Hello everyone, welcome back to Trading Club Q7U. I'm your lead educator, and today we're diving into a crucial concept for all traders to understand: bullish and bearish candles. This lesson is part of our Candlestick Masterclass module, and I'm excited to help you remove any confusion you may have about these fundamental concepts. So, what exactly are bullish and bearish candles? Simply put, they are two types of candlestick patterns that appear on charts to indicate potential market movements. Imagine you're driving on a road, and you come across a traffic light. If the light turns green, you know you can go forward. If it turns red, you need to slow down. Bullish and bearish candles are like those traffic lights for traders. They provide signals about the market's potential direction. Now, let's break each type down. Bullish candles, also known as green candles, form when the close price is higher than the open price, and the close price is higher than the high price of the previous day, or the close is above the previous day's high and the low. Think of it like a strong upward movement. The price has rallied, and the traders are feeling optimistic. Bullish candles can be subclassified based on their size and the location of the close relative to the high of the previous bar. For example, if the bullish candle has a long lower shadow and the close is near the low of the previous bar, it may indicate a potential reversal. This is because the price moved up but then fell back down, which can be a sign of market indecision. On the other hand, bearish candles, also known as red candles, form when the close price is lower than the open price, and the close price is lower than the low price of the previous day, or the close is below the previous day's low and the high. This means the price has dropped, and the traders are feeling pessimistic. Bearish candles can also be subclassified based on their size and the location of the close relative to the low of the previous bar. For example, if the bearish candle has a long upper shadow and the close is near the high of the previous bar, it may indicate a potential reversal. This is because the price moved down but then rebounded, which can be a sign of market indecision. Let's use a simple example to illustrate this. Suppose we have a closing price of 50, an opening price of 40, a high of 55, and a low of 35. If the close is above the open and the high, we have a bullish candle. Conversely, if the close is below the open and the low, we have a bearish candle. Let's look at another example. Suppose the closing price is 40, the opening price is 45, the high is 48, and the low is 38. If the close is below the open and the low, we have a bearish candle. However, if the close is above the open, we have a bullish candle, even though the price may not have moved very much. This is because the close is above the open, indicating that the price has moved up from the opening price. Now, I know many beginners make some common mistakes when dealing with these concepts. They might assume a single bullish candle guarantees a long trade, or that a bearish candle means they should sell immediately. But remember, trading is not about making promises or taking risks without a solid understanding. In reality, trading is a probabilistic game. These candlestick patterns are just some of the many factors you should consider before making a decision. Always backtest, analyze, and understand the bigger picture before taking any action. Another common mistake is to trade on emotions rather than analysis. Many beginners will get excited when they see a bullish candle and start buying, or get nervous when they see a bearish candle and start selling. But this is not a sustainable strategy. As a trader, you need to remain calm and rational, and make decisions based on your analysis. In addition, many beginners will also ignore the context of the market. A bullish candle on a trending market may be just another wave of the larger trend, while in a range-bound market, it may indicate a potential breakout. You need to consider the market structure and the overall trend before making any trades. Now, let's move on to your practical homework exercise. Choose a currency pair or stock, and take 510 minutes to study the past 1015 candles on a chart. Identify which ones are bullish and bearish. Then, imagine which trades you would take based on these patterns alone. Write down your decisions in a paper trading journal or use a demo chart to practice. For example, let's say you're looking at the Apple stock chart, and you see a bullish candle with a high close above the high of the previous bar.